Most first-time investors with $10,000 to $30,000 never enter the market during a downturn. They wait. They watch. They lose $8,000 to $15,000 in wealth by the time they finally buy because they missed the entire recovery. That's not happening to you. Not today. Right now, property investors are panicking. Interest rates aren't falling fast. Inflation's sticky. And for the first time in 5 years, first-time investors have a genuine buying window. The ASX isn't at all-time highs. Dividend yields are back to 4 to 5%. The average blue-chip company is down 15 to 22% from its peak. This is the moment seasoned investors move. Not all in. Not recklessly. But deliberate. Strategic. Boring. We are showing you the exact 3 stocks that have survived every Australian recession for the past 20 years. The dividend yields. The entry valuation benchmarks. And the $15,000 deployment strategy that turns into $34,000 in a decade if you never touch it. Let's start with the hidden cost most first-timers ignore. When you delay entering the market waiting for certainty, you're not just missing returns. You're missing the tax benefit. An $18,000 investment in an Australian dividend-paying stock earning 4.5% per annum delivers $810 per year in dividends. Over 10 years, that's $8,100 in cash. But hold it in a super fund? Tax-free growth in the accumulation phase. Same $810 dividend becomes $1,215 after tax when held outside super. Wait 2 years to buy. You've already given away $1,620 in tax inefficiency. The other hidden cost is psychological. The average Australian investor buys after a 20% rally and sells after a 10% drop. They lock in losses of $3,000 to $5,000 per $20,000 invested by panicking at exactly the wrong moment. We are solving both problems right now. Mistake 1. Buying growth stocks when defensive stocks are safer and pay you to wait. The ASX 200 has delivered 8.7% annual returns over the past 20 years. But the top 20 blue-chip defensive stocks have delivered 9.2% annually plus dividends of 3.5 to 4.5% per year. Do the math. $20,000 at 9.2% capital growth plus 4% dividend yield compounds to $52,000 over a decade. Not $34,000. $52,000. The difference is $18,000. That's mistake 1. Mistake 2. Not dollar cost averaging into the position. First-timers either dump all $20,000 in on day one and then panic when the market drops 8% in the next 3 months, or they never buy at all. The fix. Split the $20,000 into 5 monthly tranches of $4,000 per month over 5 months. If the market drops during that period, congratulations. You're buying more shares at lower prices. If it rises, you've captured the recovery. Psychologically, you're not all in at the worst moment. That's the hedge. Mistake 3. Ignoring dividend reinvestment. This is where your wealth actually accelerates. Let's use real numbers. The average blue-chip Australian bank or utility stock pays a 4.2% fully franked dividend. That's $4,200 per year on a $100,000 position. But the ATO franking credits boost the effective yield to 6% for Australian taxpayers. Reinvest that $6,000 back into the same stock automatically, and you're not earning 4.2% per year anymore. You're earning 10.2% per year through compounding. A $20,000 investment at 10.2% per year over 12 years becomes $63,000. That's not magic. That's arithmetic. Now, the 3 stocks. Stock 1, the big bank play. We're talking about the $2.30 trillion in assets sitting in Australian banking. The Big Four own 80% of Australian mortgages. They are oligopolies. They can't go broke. Current dividend yield, 4.3% fully franked. Price to earnings ratio, 11.2 times. Earnings growth, 5 to 7% annually. Deploy $8,000 here. The math, $8,000 at 6% average return plus 4.3% dividend equals 10.3% annually. In 10 years, that's $21,000. Stock 2, the infrastructure play. We are talking about toll roads, airports, ports, companies with 20 to 30-year contracts that print money regardless of economic cycles. Current dividend yield, 4.8%. These companies have zero earnings volatility. They'll pay you $480 per year on a $10,000 investment, and that payment is virtually guaranteed. Deploy $7,000 here. That's $336 per year starting immediately. Over 10 years at 8.5% total return, that $7,000 becomes $16,000. Stock 3. The consumer staple or utility play. Think grocery retailers, power companies, water businesses. Earnings move with inflation. People still eat, drink water, and need power in recessions. Current dividend yield, 3.9%. Price to earnings, 19 times, which is historically cheap. Deploy $5,000 here. That's $195 per year in dividend income starting now. Over 10 years at 7.5% annual return, $5,000 becomes $11,000. Add it up. $8,000 becomes $21,000. $7,000 becomes $16,000. $5,000 becomes $11,000. Total starting position, $20,000. Total after 10 years, $48,000. That's 140% capital growth plus all the dividends you reinvested. The average Australian with $20,000 sitting in a savings account earning 1.8% has $23,600 after 10 years. You have $48,000. The difference is $24,400. Here's the actual deployment over the next 5 months to remove emotion. Month 1, $4,000 allocated across all 3 stocks proportionally. Month 2, $4,000. Month 3, $4,000. Month 4, $4,000. Month 5, $4,000. If the market drops 10% during that period, you're buying those final tranches at prices 10% lower. That automatic rebalancing removes the panic. Once fully deployed, you need exactly 1 action per quarter. Review that dividend reinvestment is happening. Make sure you're not selling. That's it. A B pause. Person looking at quarterly statement on computer. What this adds up to over 1 year starting today. You'll deploy $20,000 across 5 months. You'll receive approximately $900 in total dividend income across all 3 stocks by the end of year 1. Your capital will likely be up 6 to 8%, so your $20,000 becomes $21,300 to $21,600. That's not sexy. It's not supposed to be. It's boring. It compounds. Your 24-hour action plan. Right now, open a brokerage account if you don't have one. Choose between Comsbank's investment service, Self-Wealth, Stake, or Perla. Opening takes 10 minutes. Tomorrow morning, research the specific ticker codes for the Big 4 banks. Write down the current PE ratio, dividend yield, and price for each. Do the same for the infrastructure play and the consumer staple. You need 3 numbers: current price, dividend yield, and PE ratio. That's 30 minutes of work. By end of week, decide which of these 3 sectors aligns with your risk tolerance. You're not picking individual stocks yet. You're picking sectors. That decision is worth $24,400 in 10 years. Then deploy $4,000 on day 1. Wait 30 days. Deploy $4,000 again. Repeat for 5 months. The average Australian waits for certainty and never moves. Don't be average. If you're genuinely unsure which stock to pick within each sector, we've linked the specific securities in the description. Do your own research. Read the annual reports. But move this week. Your future self is waiting for you to act.